Okay, turn to page 18. I figured we would just skip chapters 13 through 17. Yes, chapter 18. Chapter 18. Page 503. Y'all don't care about chapters 13 through 17, right? Good. Makes my job a lot easier. Taxation. Everybody's favorite topic. And how it relates to owning property. This is a really, really short chapter. And it just involves a little bit of math, not even a lot of math, but a little bit of math. So we want to go through this and just kind of get it knocked out of the way. So when we talk about taxes and how they impact real estate, there are two types of taxes which could impact owners of real property. Annual income taxes and something called capital gains taxes, which is when you sell the property. So there are implications both from owning real property and from selling real property, and we need to talk about both. Let's first talk about the annual income tax implications. So what are the implications for homeowners who own real property? Well, these are good implications. Owning real property, if you're a homeowner, creates tax deductions. There are certain things that become tax deductible when you're a homeowner. First and foremost, if you have loans, all of these expenses that you see here on this slide are tax deductible expenses. So the interest on up to 2 different properties is tax deductible in most cases. So even if you own a second home, which by the way could be a motor home, for example, your first 2 homes, the interest on those properties is going to be tax deductible. Any discount points that you pay when you purchase that property. We're going to talk about what discount points are when we get to the finance chapters, but discount points are a form of prepaid interest. So since the mortgage interest is tax deductible, then prepaid mortgage interest would also be tax deductible. So discount points. Origination fees, that's another loan-based expense that would be tax deductible on your annual income taxes. So what that does is it reduces your annual taxable income. So if you reduce your taxable income, what do you also reduce? Your tax bill. Your tax bill. So all those are benefits to homeowners who have a loan. This is a benefit to all homeowners regardless of whether or not they have a loan on the property. The annual property tax bill on your home is a tax deductible expense. So any homeowners would be able to deduct their annual property tax. So what that means is that people who are homeowners are going to pay substantially less in income taxes than somebody who rents, for example, because somebody who rents does not have the benefit of taking these tax deductions on an annual basis. So if you're weighing out the cost of ownership versus renting, this should probably come into play there. You should figure in what the tax benefits are of owning a property. Is everybody good on these? Just a quick, you don't have to know how to calculate tax deductions and that sort of thing. You just need to know in general what expenses are tax deductible when it comes to doing your annual income taxes. We good with that so far? So now let's talk about the one that is much more heavily focused on in this chapter, something called a capital gains tax. A capital gains tax is a tax when you sell. If you sell the property and you make a profit from the time you bought it to the time you sold it, that profit's called a capital gain. And if you make a profit, guess what you get to do on that profit? Pay taxes on that profit. So when you sell a property and you make money, you have a capital gain and you pay a capital gains tax on that property. Now, long-term capital gains are gains on properties that you have owned for a year or more. Back up. Short-term capital gains are capital gains that you've owned for less than a year. So if I bought the property and I sold it 9 months later, that's going to be what kind of a capital gain? Short term. If I bought it 5 years ago and I sell it now, it's a long term. Here's the difference in that distinction. Short-term capital gains are treated as regular income. If you own the property for less than a year and you sell it, like flipping houses, for example, y'all watch those shows, you know, Flip or Flop. I think that was a reference to their marriage, by the way. Couldn't resist. But if you are flipping houses and you own them for less than a year, that is a short-term capital gain. And what that means is you're going to pay taxes on that gain at whatever your normal income tax rate is. So if you're in a 25% tax bracket, you're going to pay 25%. If you're in a 30% tax bracket, you're going to pay 30%. If you're like Tina in the 36% tax bracket, you're going to pay 36%. For people, what is that? People that make $496,000 a year, I think is the 36% tax bracket. So it does matter whether they're long-term or short-term, because if it's a long-term capital gain for the vast majority of the United States, all long-term capital gains are going to be taxed at 15%. There's a huge difference there. I mean, even if you're in the 25% tax bracket, there's a huge difference between the 15% tax and a 25% tax. So there's a lot of times a very big benefit to owning these properties for at least a year before you sell them. And capital gains tax doesn't just apply to real estate. We talk about it just as a real estate thing because this is a real estate class. But it also applies to things like stocks and bonds, for example. If you buy stock and sell them and you own it for less than a year, it's a short-term capital gain. If you own them for longer than a year, it's a long-term capital gain.
Is this nationwide or North Carolina?
Nationwide. Nationwide. This is federal tax law. And capital gains taxes could go as high as 20%, but that's only for people who are in the 36% and higher. What does it go up to? 39, I think. The 39% federal tax bracket. So you'd have to be at the absolute top tax brackets to get to a 20% capital gains tax. Most of us will always fall within the 15% capital gains tax bracket on long-term capital gains. And that's properties you own for longer than a year, from the time you purchase to the time you sell. Okay? Is everybody good on this idea so far?
Is there a law or something to the effect that if you sell it and you don't get taxed if you buy another home?
We're going to talk about that. It's called, Dennis's question is about something called a 1031 exchange, and we're going to talk about that, about being able to delay paying the tax. Okay? So let's get there first. Okay? So everybody understand the basic idea of a gain. It's if I sell the property and I do what? Make money, then I'm going to pay taxes on the money I make. And most likely at what rate? 15%, as long as I've owned the property for longer than 1 year. Okay? So in your formula packet that you got at the very beginning of the class, you have this slide in here. This is the method of calculating a capital gain. So you could go back and look at it in the formula packet if you wanted the full screen version, for example. But the method of calculating a capital gain is really simple. This is one of those things, folks, where you can't lose sight of the forest for the trees. You sit there and you start trying to memorize these formulas and you have no earthly idea what you're trying to accomplish. Remember, a capital gain is just the amount of profit you made from buying it to selling it. Does that make sense for everybody? So let me give you an example of what I mean, because we're going to make it more complex, but not much. If I buy a used car for $500 and I sell it for $2,000, what's my gain on that sale? $1,500, right? Well, what if I gave you some wrinkles at it? I told you, well, yeah, I bought it for $500, but I spent another $500 fixing it up. Would my gain still be $1,500? Now my gain is $1,000 because I actually invested $1,000 in the thing. Does that make sense for everybody? If I paid $500 for it and I spent another $500 fixing it up, my gain is not really $1,500, it is $1,000. And if I had to pay $100 to put it in the newspaper to sell it, would my gain now be $1,000 or would my gain be $900? You notice how it's getting smaller and smaller all along, right? A capital gain works exactly the same way. It's not just what I sold it for minus what I paid for it. We adjust those numbers to account for other factors. So when we talk about what I paid for it, it's not just what I paid for it in the beginning. It's what I paid for it plus all the other money I've invested in the property. Does that make sense for everybody? So we call that the adjusted basis. The adjusted basis is what I've invested in the property. So it includes not only the purchase price, but it includes things like closing costs. It also includes improvements on the property. So if I renovated the property, if I put in new kitchens, new countertops, if I replace the roof, if I put in new siding, new flooring. Notice what word I keep consistently using there. New, replace. Maintenance is not a capital improvement. So I wouldn't count things like basic maintenance, but I would count renovations in that. Is everybody good with that? That's going to be my investment in the property. That's the adjusted basis. Now this other one, the amount realized, that's what I got out of it when I sold it. So yeah, I sold it for $250,000, but what kinds of money am I going to have to pay out of that before I ever see a dime of that $250,000? Commissions, big one. So would we take commissions out of it before we plug it into a capital gain formula probably? Yeah. Closing costs, attorney's fees, all those things that go along with selling it. Here's what you don't take into account, ever, when it comes to capital gains. Loans, and anything related to a loan. Loan balances, how much I borrow, origination fees, discount points, all of those things relate to a loan. Ignore them. They don't have anything to do with it. Your capital gain or your capital loss is based strictly on cash prices, not loans. No interest, no nothing. This is take the loan out of the picture. Due diligence fee is part of the purchase price. Remember, that's part of the, so that's taken into account when you do the purchase price. That's a good question, though. Okay? Is everybody good on the basic ideas here? Good with this? So, here's an example. It says Travis purchased an investment property in 2005 for $150,000. And he's selling it now for $228,000. He incurred closing costs, the attorney's fee, the appraisal, the inspection of $1,500 when he purchased the property, and he's done renovations to the property totaling $32,000. At closing, he's paying a 6% real estate commission as well as excise taxes of $456 and attorney's fees of $400. What's his capital gain on the property? So now, one of the things I recommend you do here, and I think it makes it a lot easier, is make yourself a couple of different columns. If you'll make yourself a couple of different columns, like when I bought it and when I sold it, just kind of group the numbers together before you start trying to do any math. I think it helps a lot because the bought side is the adjusted basis. And the sold side is the amount realized. So if I look at this slide again, and I start grouping those things together, I purchased an investment property in 2005 for $150,000. What column is that going to go in? That's the bought column, right? Okay. I'm selling it for $228,000. What's that going to go in? The sold column. He incurred closing costs, attorney's fee, appraisal, and inspection of $1,500 when he purchased the property. So what am I going to do with that $1,500? Bought column. And he's done renovations to the property totaling $32,000. Which column am I going to put that in? That's also bought. That's money I've invested in the property. At closing, he's paying a 6% commission. Where's that going to go? Sold. At closing, he's paying a 6% commission. That's going in sold, as well as excise taxes of $456. Where's that $456 going? Sold. And attorney's fees of $400. What's his capital gain on the property? Well, if I go over here and I take a look at this and I just start putting all those things down into columns like we said, let me get it flipped over here where I can read it. Okay, so I said he purchased an investment property. That's going here, $150,000. He's selling it for $228,000. Okay, and I said $1,500 is going in bought for the closing costs, as well as $32,000 for the renovations. The 6% commission, 6% of what number? 228. So what is 6% of 228? I got $13,680. Does that sound right for everybody? Yeah. $13,680. So I'm going to put it in my sold column over here. As well as excise taxes of $456. That goes in my sold column. And attorney's fees of $400. That goes in my sold column. So here's the trick to this thing. Everything on the bought side is a plus. Add them all together. Because we're trying to beef up what we paid for the property. What do you think we're going to be doing on the other side? Trying to minimize what we got out of it. Because the goal is to minimize our tax, right? And we do that by minimizing our gain. So if we add everything up on the bought side, we've got $183,500. Does that make sense? That is my adjusted basis, $183,500. Then on the sold side, I start with my sales price and I just start subtracting all these other numbers out of there. What do you come up with for an amount realized? $213,464. Your capital gain is just the difference between those two, folks. So if you take $213,464 and subtract $183,500, what do we come up with for a capital gain? How much? $29,964. Hopefully that's what the slide says too. Look at that, it does. So this is just an example of running that all out. Is everybody okay with how you do that? I think putting it in two columns is the easiest way to do it, just kind of separating them out to two sides, what I bought, what I sold, and then do the math at the end. We go okay with that? Now, we could also go one step further. That's the gain. We could also calculate the tax due on that gain times 15%. If the tax rate on a long-term capital gain, and we know it's a long-term capital gain because he bought it in 2005, it would be 15%. So $29,964 times 15%. The capital gains tax that would be due is $4,494.60. Is everybody okay with that? Math's not too complex here. There is one wrinkle that we need to throw in. Of course, there always is, right? There's always an exception, not so fast. And there is one here. And it's actually a really good exception for all of us. What is this? My house. It's not mine, actually. It's just a picture of a house. But for purposes of this discussion, it's going to be my house because I want to sell it and not pay any capital gains taxes. The good news for all of us is that we can do just that. Because there is one huge exemption. Exemption just means you don't have to follow the rule, right? One huge exemption from capital gains taxes is selling my primary residence. If I am selling my primary residence, then I do not have to pay capital gains taxes on that sale, most likely. The only way I'd have to pay any capital gains taxes is if I had more than a $250,000 gain on that property if I'm single, or more than a $500,000 gain on that property if I am married. Think about that. That is a huge gain. And I pay zero in taxes on it for the first $250,000 if I'm single, the first $500,000 if I'm married. Now, what if I had a gain of bigger than $250,000 and I'm single? Do I pay taxes on the whole thing, or do I take away the first $250,000 and just pay taxes on the top?
Take away the first $250,000 taxes on top.
Does that make sense? Everybody good with that? I'm just going to eliminate the first $250,000. So, example, if I had $260,000 gain, I would pay taxes on how much money? $10,000 at 15%.
Do most people ever pay it like this? Because it just seems like most people are exempt.
Most people are exempt. So most of the time when you're looking at capital gains taxes, what kind of property are we talking about? I'm sorry? Investment or commercial property. That's exactly right. In some type of income producing property, because the vast majority of people will never experience this kind of gain on their personal residence. So the last thing you need to know about this exemption is, how do we define it as a personal residence? The IRS defines it this way. If you have lived there for 2 of the previous 5 years, then it's your primary residence. If you've lived there for 2 of the previous 5 years, then this is your residence. And you can take this exemption an unlimited number of times during your life. You're eligible for it once every 2 years. So in theory, you can sell your home every 2 years, and if there's a gain, never pay any capital gains taxes on the property.
Is that 2 consecutive years?
Doesn't have to be consecutive. As long as you look back 5 years and cumulatively in that 5 years you have 24 months worth of residence in that property, then you can sell it as your primary residence. So presumably if it was like a seasonal home, say you live there 6 months out of the year, but you've owned it for 4 years and lived there 6 months out of the year for 4 years, you can sell it as your primary residence because you can add up to 2 years in the previous 5. Okay? Everybody good with that? Understand the exemption. Understand what a capital gain is. Then we're doing all right. So here's an example with the exemption. It says Diane is selling the home that she and her husband have owned for the last 38 years. They originally paid $148,000 for the house. I'm going to switch over to my screen here where I can do my columns. I'm going to do the same thing. Bought, sold, okay. They originally paid $148,000 for the house. That's going in my bought column. And incurred various closing costs totaling $900. What column is that going in? The bought column. Over the years, they've done several major renovations totaling $185 in capital improvements. What am I doing with that? Bought column. They are under contract to sell the home for $752,000. Where's that going? Sold. And will pay their listing firm a 5% commission on the sale. So, well, 5% equals $37,600 in the sold column. $37,600. Additionally, they must pay state excise taxes and attorney's fees. Well, they didn't tell us how much the excise taxes are, so what do they expect us to do? Figure it out. How do we figure out the excise taxes? 752 divided by 500. So that's $1,504 in excise taxes, and that's going in the sold column, plus the attorney's fees of $250 is going in the sold column. And they want to know, what will the capital gains tax be on the sale? Well, what am I doing on the bought side? Everything's a plus over there, right? So if I add the 148 plus 900 plus 185, 333, 900. And then if I add it or subtract everything on the sold side, 752 minus 37,600 minus 1504 minus 250, 712, 646. So we want to calculate our capital gain. That's going to be 712. Can't write. 712, 646 minus 333, 900. So they got a capital gain of $378,746. But the question wants to know, how much will their capital gains tax be? So to answer that question, we always have to ask ourselves, do they get the exemption? Is this their primary residence? And what's your answer there? Yes, it is. So are they single or are they married? In other words, what number am I subtracting? Am I subtracting 250 or 500? So if minus 500, I don't need to do that math to know that's going to be less than 0, right? So how much of a taxable capital gain do they have here? 0. How much tax do they owe? None. No tax. Does everybody understand how that exemption works there?
Right. But if Diane was single, then you would just deduct 250,000.
If Diane had been single, I would subtract 250 to figure out how much her taxable gain would be.
If you knew it was her primary residence, then if they lived there without any break points, you would have to do anything. I mean, they've been there more than 2 years, since they've been there for the last 38 years.
Right, we know it's their primary residence for sure. The question is it 250 that's exempt or 500? Since they're married, it's the 500. What Sarah's question was, if she was single, she would just have subtracted 250 from that. You see what I'm saying?
Yeah, I get that. I'm just saying that if they've been there for 2 of the previous 5 years, you don't have to do any math. You would just know they don't pay any capital gain.
No, that's not true, because we got to make sure how much the gain is, because it's the first 500,000 that's exempt. If they had a gain of more than 500,000, they would still, regardless of how long they've been there, they'd still have some capital gains tax. I'm glad I kept needling at it.
Is new AC or new roof considered maintenance items?
No, those are capital improvements. The word new or replace is always going to be capital improvement. Okay?
So we would need a receipt then for roof?
Yeah, well, you know, the answer with taxes, the question is, do I need a receipt? The answer with taxes is only if they come looking for one. You know, they don't ask for receipts when you file. They ask for them later on when that word audit comes into play. So I would certainly suggest you have receipts in case you ever need them.
Because I can see where people may forget or they may not know if the insurance covers the roof.
And now if the insurance covered it, you're not going to be able to count it as a capital expenditure for yourself. Exactly. Because you didn't spend that money. Okay? But that's how you calculate the basics of a capital gains tax. Is everybody okay on that? So then that only leaves us with one slide left. And this goes to Dennis's question earlier. Dennis, sneaky as he is, wanted to know if we could avoid paying these capital gains taxes even if it's not our primary residence. Is there a case when it wouldn't be our primary residence where we could avoid paying the capital gains tax? And the answer to that is yes. We can at least delay it for a very long time. If we sell this property and we don't touch the proceeds. That's a big if, right? We cannot touch the proceeds at all, not $1. If we sell it and we don't touch the proceeds from it, and in fact we immediately reinvest those proceeds in what the IRS calls a like-kind property. And like-kind is a pretty open definition for them. Real estate for real estate. This is why it's a 1031 exchange. Because you're selling one piece of real estate and you turn around and doing what with the profit? Reinvesting in another piece of real estate. If you do that, you defer paying the capital gains tax. Defer means delay, right? The implication is that eventually you will do what? Have to pay. Eventually you're going to sell and cash the money out. And that is mostly true. Unless you die. Which some of us tend to do from time to time. Because when you die, your heirs inherit your property, correct? And what gives us a capital gain? What gives us a capital gain is when we sell it for more than what we've invested in it, right? When our amount realized is bigger than our adjusted basis. Our heirs are not going to inherit it at our adjusted basis. They inherit it with an adjusted basis of its current market value. And so what that means is that they can sell it on day one after they inherit it, and their capital gain is going to be zero because they're going to sell it for what they invested in it. And what's the gain? Nothing. And if the gain is zero, what's the tax? Zero. A tax deferred just became a tax avoided. Never paid. I'm sorry? Well, you would pay an estate tax only if your estate exceeds the estate tax limits. If it doesn't, then you wouldn't. You'd pay zero. Yes?
So if you 1031 for another property, is the IRS going to say anything if you, like, then when you get that property, then you like a cash out refi and get the money, like, to get the profit like that?
Loans don't matter.
So you could take.
Because what do you have to do with the loan?
No, I meant for the new property.
I understand, but eventually what do you have to do with the loan?
Oh, yeah, pay it off.
You got to repay it, so loans don't matter.
So technically you could get that money back out almost immediately.
Yeah, as long as you're willing to repay it. Sure, you can borrow it, but you're going to be repaying it with interest.
No, that's not what I mean. So I mean, like, okay.
I think it is what you mean, but you don't understand what a cash out refinance means. I think that's the issue. I know exactly what you're saying. You buy a new property, you didn't reinvest the money, and then you go borrow the money to get the cash, right?
No, well, yes, I guess that is. Just taking it, because since that money was originally from the other property, right, you had. the
Right.
money from
The
first
proceeds from the first property.
property, you go and get another property.
Mm-hmm.
Can you take money out from that new property?
There's no such thing as taking money out from a property. It's not a piggy bank.
Well, that's why I said.
That's what I'm saying. You're thinking of a loan in the wrong terms. It's not a piggy bank. You're still not touching that investment because what you're doing is borrowing against the value of the property, and loans don't have any impact whatsoever on a capital gain. So, but again, you're repaying that. That's not.
Technically repaying it.
Not technically, you are repaying it. You find out how technical it is when you don't pay because they will foreclose and take it. There's no technicality there. You are explaining perfectly. The problem is you're being stubborn and you're not listening to what I'm telling you. And this happens all the time with finance. All the time. People look at finance in the exact wrong way. You are not touching your investment in that property when you borrow money. If I own this watch, and I go into a pawn shop and I borrow money against this watch, I have not touched the money that I invested in this watch. What have I done? I've borrowed money against the value of the watch. Those are two different transactions, and one does not impact the other. And so her question is, can she borrow that money, and is that a way to avoid paying the capital gains tax? Well, sure. But I guarantee if you do the math on how much you're going to pay in interest on that note versus how much you'd pay in taxes, you'd be crazy to do it to avoid paying the tax that way.
Well, the reason I ask that is because I read a lot of stuff from investors, and so they'll buy a new property, fix it up a little bit, make it be worth more, and then they'll, take the cash out. Of course now it's worth way more than it originally was, and they'll take the money out. And so I was wondering, would the government then say, oh no, all that extra money that came from that property that you didn't take?
So they're borrowing the money.
Well, the new property now is worth a lot more.
So are they selling it or are they borrowing against it?
They took the first property, and okay, let's say they did exchange, and then they'll turn around and take like a HELOC or just.
So they're borrowing the money. Has no impact. Has no impact on a capital gain because they're borrowing the money. That's what I'm saying. You have to draw that line in the sand mentally. You thinking of it as one pot of money. That's not the way it works. A loan is a completely separate thing. I would say any investor who looks at that as a good strategy has not done the math on what that interest is going to cost unless they're talking about a very short-term loan. Because within a couple years, you're going to easily outstrip in interest what you would have paid in taxes in the first place. Okay? But I get completely where you're coming from. I just want to make sure you get where I'm coming from. Which they're so separate. They shouldn't even be in the same realm of discussion. I don't know why y'all packing up. I got 20 more minutes. Okay? You okay?
Yes.
A loan is a different thing. A loan is a different thing. We haven't even talked about them yet. Yep, they are completely different things. It is not touching that. It is not touching the proceeds of the sale to go out and borrow against the equity you have in the property. Okay? That's a different deal. It's a different deal. Anytime there's an interest rate attached, those are not proceeds. That's a loan. Okay? So for your homework for this weekend, I handed out a math packet of capital gains tax questions. So go ahead and do those, and we will go over them next week. Now, big homework for next week. You're going to hate me. Read chapters 14 and 15. They are miserable. But you got to read them. The finance chapters. I highly, highly recommend you go and watch the videos that are online from chapters 14 and 15.